In this episode, we're going to teach you how your 1 share of Tesla stock can turn into 3. The importance of this possibility is not what you think.
We'll also cover the one result of stock splits that nobody is talking about. But don't worry, we got you. There are 2 types of stock splits, forward and reverse. When someone says stock split, they're implying that it's a forward stock split, unless someone says reverse stock split. In this episode, we won't touch on reverse stock splits, but you'll probably understand them by the end of the episode. Let's say stock A trades at $75 and has 1,000 shares issued. This gives it a market cap of $75,000, 75 per share, with 1,000 shares outstanding. The company then implements a 3-for-1 stock split. For each share shareholders currently own, they receive 3 shares. They now have 3 shares for each one previously held, but the stock price is also divided by the ratio, in this case 3, from $75 to $25. Notice that the market cap stays the same after the split, tripling the number of shares outstanding to 3,000 while simultaneously dividing the stock price by 3 to $25, resulting in a market cap of $75,000. So the true value of the company has not changed at all. Let's break this down even simpler. If I own 1 share worth $10 and the company then implements a 2-for-1 stock split, I would then have 2 shares, $5 each. I have the same value in share price. The only change is how I own that $10 in value. Now, if a company were to do a 3-for-2 stock split, which is common, you determine the share price the exact same way. You just divide the previous price by the ratio. 3 divided by 2 is the ratio, which is 1.5. If you take the same share price of $75, divide that by 1.5, you get a new share price of $50 per share.
The major takeaway here, the stock split itself does not change the value that you own.
Apple and Netflix have both implemented stock splits in the past 10 years. Apple's was 7-for-1 with the share price around $630 back in June 2014. Netflix was also similar with a 7-for-1 split with the share price around $650 in July 2015. Both, interestingly enough, in the summer, both 7-for-1, and both with share prices in the $600 range.
With that out of the way, let's now talk about why the board of directors would choose to do this.
The most often discussed reason is changing the entry point for retail investors and fans. It's simple. With Tesla trading at over $1,300 per share, another round of stimulus checks will not afford someone the ability to buy even 1 share. Yes, you can now buy fractional shares, but that's a topic for another episode. A stock split changes the entry price point, making the stock price more palatable for a wider group of investors. If Tesla were to implement a 30-for-1 stock split, the share price would drop from $13.70 to $46 per share. The more people that can invest in shares of Tesla means more people following the company, the younger generation now having access to a lower entry point. This same demographic is more likely to grow up and support the company they're invested in, eventually buying Tesla products and evangelizing their inner circle. It's impossible to price these ripple effects into the long-term performance of a stock. As we just talked about yesterday, kids and youth already love the brand of Tesla.
And if you want to frame a stock certificate and put it on your wall, I'm pretty sure no one wants to put $1,400 on their wall.
She has a point, unless you're a baller. But another reason that people fail to mention is increasing the liquidity of the stock in the market. This does indeed play a role in the volatility of the share price. It's also simple. With more shares available in the market, traders and investors have more flexibility to rebalance portfolios and to capitalize on price swings. If an investor has 50 shares and sells 10, he's just liquidated 20% of his portfolio. If this same investor has 150 shares after a 3-for-1 split and he sells the same 10 shares, he's only liquidated 6.6% of his portfolio. To this point, I think it's important we quickly cover the bid-ask spread, which is what makes the market. This will help you better understand the liquidity aspect. The bid-ask spread is a two-way price quotation that indicates the best price at which a security can be sold and bought at a given point in time. We'll use Tesla's actual data to illustrate. The bid price is the maximum price a buyer is willing to pay for one share. The ask price represents the minimum price a seller is willing to accept for one share. The difference between these numbers is the spread, a key indicator of liquidity. The smaller the spread, the better the liquidity, which makes sense as it's a buyer and seller being closer to coming to an agreement of price for a transaction to take place. The spread also represents the market maker's profit. Stocks with prices too high or too low can have spreads wider than similar stocks. Tesla's current bid is $13.89 and their ask is $14.00, resulting in a spread of $11. A stock split can help keep the spreads lower, helping to maintain liquidity and stabilizing stock prices.
Historically, the perception around a stock split has been positive. It has signaled that a company is feeling confident in their operations.
There are many debates in behavioral finance about whether stock splits help or hurt investors. One side argues a stock split is a good buying indicator, signaling the company's share price is increasing and doing well. This may be true, but a split in and of itself has no effect on the fundamental value of the stock. There are entire publications devoted to tracking stocks that split, attempting to profit from these actions. Critics would argue this strategy is by no means a time-tested one and is questionably successful at best.
So if I worked in Tesla's accounting department, I would have to say no to the stock split because then it's more paperwork for me and a lot of mumbo jumbo.
Once again, she has a point. It does require a bit of admin work. However, a probably more important reason not to do a stock split would be to keep the share price high. This will eliminate the fickle or average investor who is more likely to trade on a whim. So if the stock price is higher, this will attract more serious, long-term investors helping to stabilize the share price. Just ask Warren Buffett, whose Class A shares are trading at $272,000 per share. You heard that right. This is kind of a baller power play if you ask me. One could also argue that a higher stock price for Tesla would hurt their inclusion chances into the Dow Jones. The Dow is a price-weighted index, meaning if their share price is too high, it may be too high relative to the other 29 companies in the index. With the influx of retail investors in today's trading age of apps and zero fees, the game has changed. As you can see on the RobinTrack tool that tracks stock ownership on Robinhood, the number of investors owning Tesla shares has gone from around 120,000 to start the year up to over 370,000 holding shares today. A higher number of shares available to retail investors would help to keep the Tesla share market more liquid as new investors undoubtedly pile in for FOMO.
There have been a few studies done that show market outperformance after a stock split.
A NASDAQ study that analyzed splits by large cap companies from 2012 to 18 found a 4.8% market outperformance over 1 year subsequent to the stock split. Dr. David Eikenberry, professor of finance, published papers in 1996 and 2003 analyzing more than 1,000 stocks showing an average of 8% outperformance relative to the market over 1 year and 12% over 3 years. I'm not arguing by any stretch of the imagination that a stock split guarantees stock outperformance, but there are certainly ways to slice the data that can prove that point. As you should know, investor behavior is not always tied to logical or rational behavior.
After all of this, my question would be, why wouldn't Tesla just do a 50-for-1 split so that anyone could just buy in?
This is a good question, but the issue is if the share price were to drop too low, some hedge funds and mutual funds may have to liquidate shares due to regulations that these fund managers have in place. So Elon has said that this topic is worthy to be discussed at the annual shareholder meeting. It was supposed to be today actually, but it's been rescheduled to September 15th of this year, along with Battery Investor Day. We're definitely going to have a lot to talk about this fall. I honestly can't wait. So let me know what you guys are thinking about a stock split. What would you like to see? Personally, I think a 10-for-1 would be legit. It'd bring the stock price down to about $130 per share, and people can just add a 0 to the number of shares that they already own. So thank you guys for watching. I'll catch up with you guys soon.
All right, you guys, I hope you learned something new today. If you guys missed our episode on S&P 500 inclusion, go check it out right here.